Hi everyone, so this is my second discussion post and it's also on watch insurance pricing, but these sort of trends and uh, comments that I'm going to make sort of extend to all types of jewelry insurance. As a little bit of a reminder of what I spoke about in my first discussion post, I actually undertook watch insurance through Jewel Cover, which is underwritten by Chubb Insurance. When pricing watch insurance products like my Jewel Cover policy, insurers rely on various historical data sources and market information to form their assumptions. Effective pricing actually requires a careful consideration of factors that influence both the likelihood of a claim as well as the size or severity of the claim. That's obvious, that's true for all types of insurance, but I want to speak about some broader economic and consumer behavior patterns that particularly influence things like jewelry insurance. Okay, so the factors that I want to talk about are obviously claim rates and loss data, but also market trends and watch valuations and how that affects pricing, as well as interest rates and other external data sources that affect the pricing of watch insurance as well. Okay, so when looking at claim rates and loss experience data, it's important to think about the reasons why someone might make a claim on their jewelry insurance policy. And I think there's really three reasons why might make the claim. One is um, because of accidental damage, the other is theft or loss, and the third is fraud, which I don't recommend, but do what you wish. So, of course, in order to be able to determine the frequency of these claims and the severity, insurers have to look at their own internal data as well as data that might exist amongst greater insurance associations and regulatory bodies and look at those historical claims relating to trends in accidental damage, theft or loss incidents, as well as fraud. So, in terms of accidental damage trends, frequent claims for accidental damages necessitate higher premiums to mitigate financial risks for insurers. That's not just true for accidental damage, but that's true for loss and theft as well. And yeah, benchmarking against industry's data ensures competitive pricing while maintaining insurer profit margins and sustainability. The next thing that I want to talk about is market trends and watch valuations. So this is not really relevant to repairing a broken watch, particularly because you just make a claim and say this is your preferred repairer and it gets repaired and the insurer pays it out. But this is more relevant to loss or theft. So luxury watches are often subject to a lot of market volatility, and this was particularly seen during COVID when many middle class individuals who had access to larger amounts of disposable income drove a surge in the demand for luxury timepieces. This actually increased their resale values. Now, when insurers try to replace watches purchased by the policyholder, if it can't be repaired, insurers have to replace it. And when they do this, insurers have to make sure that they price their watch insurance accordingly and have to monitor such things as secondary market data, and this is from auction houses or watch marketplaces, as well as any retail partners that they may have, as well as historical appreciation rates for luxury brands, particularly certain brands like Rolex or Patek Philippe, where they do increase in price over the years. There are also macroeconomic factors that may influence consumer spending on luxury items, and this is used to help predict or manage trends in the future about what future pricing could look like as well. The next thing that we need to talk about are interest rates and insurer profitability. I think this is quite obvious because insurers generate their income by investing premiums before claims are made. So interest rate data is important for their internal modeling and determining their expected investment returns. Of course, if you have periods of low interest rate returns, well, then you'd have to charge higher premiums versus when you have high interest rate returns, then you can manage that increased profitability with lower premiums, which might attract more consumers. The next thing we need to talk about is demographic and customer behavior data. So, consumer behavior provides insights into the likelihood for making a claim as well as the longevity of a policy. So, there's relevant data that insurers use, including demographics such as age, income, and geographic location, ownership patterns indicating how frequently their target market might purchase or insure their luxury watches, as well as customer retention and lapse rates from past policies. So lapse rates track how often customers cancel or fail to renew their policies. High lapse rates may be observed when premium increases are poorly managed or when competing insurers offer more competitive pricing. It's really important to understand lapse rates because it allows insurers to refine their pricing models much better in order to be able to retain their policyholders. And there's, of course, other external data sources. So this includes regional crime statistics. Analyzing regional crime statistics enhances death risk assessments, and it also influences premiums based on local security environments as well as the harshness of their laws. Inflation and depreciation, this obviously affects the costs that are incurred by the insurer when repairing or replacing watches, as well as consumer sentiment analysis in terms of greater macroeconomic factors, whether people are spending money on luxury goods and therefore the necessity for having things like watch insurance. That's the end of my presentation. I hope you got something out of it.